Okay, I hope I am audible. If there are any issues, please do let me know. In this session, we shall try to understand how financial management has its relationship with other disciplines or other subjects. The first one among that is we shall try to discuss how financial management and economics are, you know, have a relationship among themselves. Now, as we had discussed earlier, there are various economics theories which provide guidelines to financial manager for decision making in real business situation. Now, a finance manager must have understanding of microeconomics or economic concepts like how demand and supply analysis is being conducted, behavior of cost, pricing theory, marginal analysis, and profit optimization models. How does this all work under different market situation? Now, understanding these becomes very important, or it has a very great relevance to financial manager when it comes for budgeting, forecasting, evaluating, or selecting an alternative investment proposal for profit planning. Not only regarding this, but also when a manager has to take decisions regarding fundraising, a finance manager should have good understanding of functioning of financial institutions and also market. Maybe concepts like present value, economic income, opportunity cost, risk management, all this becomes important. And when we speak of economics also, financial managers should understand the behavior of investors under different market situations, and also maybe under macroeconomic variables like inflation, employment, per capita income, aggregate demand, and aggregate supply. All these concepts that we take from economics will have very much implications for a financial manager in understanding the different situation and also in knowing different aspects of economy. Okay. Moving forward, the next one we shall try to understand how financial management and accounting are linked to each other. Now, financial managers always or almost maximum number of times have to take decision about future, and to take decision regarding future they will have to make extensive use of historic accounting information, and this helps them to take decisions regarding or analyzing the past performance and thereby forecast about future profitability, liquidity, and also the solvency of the firm. So, as one of the important users of all this accounting information, a financial manager should be capable of understanding and interpreting financial information. For that matter, maybe it cost accounting or management accounting are also specialized areas of accounting which definitely provides accounting information in exactly that particular form which facilitates a financial manager in taking efficient decisions. Now, as a financial manager, he should also oversee preparation of financial statement. Not only that he oversees that the financial management or financial statement are being prepared, the statements which are being prepared should always be according to legal and statutory requirement, and this is how accounts and financial management are having relation with each other. Now, moving forward, the next one is we shall try to understand how financial management and statistics are involved. Now, in contemporary times, financial management, as we discussed earlier, has become more analytical and empirical. Now, to state in very, very simple words, analytical means being reasonable or logical in making decisions, and empirical means being very, very clear or exact to a point. Now, being analytical or empirical definitely requires application of large number of statistical tools and techniques, and these could be, to name a few, like central tendency, measures of dispersion, it could be correlation and regression, it could be sampling and estimation, or sometimes it can also be hypothesis testing on raw data. Now, understanding all these different tools of statistics becomes important for a financial manager to derive meaningful interpretation and conclusions. And also, these different tools and techniques that we discussed are being widely applied across all decision areas of financial management. It could be in the field of capital budgeting, it could be in the field of capital structure, it can be in a dividend or also working capital, to name a few. Now we shall try to understand how financial management and top management are interdisciplinary in nature. Now, it is the top management or those who are in the top level of the organization are those who formulate and implement strategy with one aim to maximize wealth of shareholders and also to achieve all those strategies, goals and objectives that has been mentioned of business. For that matter, all strategic decisions like strategic alliances or going in for a joint venture decision, or it could be merger or acquisition, or it can also be demerger. All these decisions that top level management makes will have significant financial impact on profitability, liquidity, and solvency of the firm in long run, definitely. So the top level management along with the chief financial officer, or what we term as a CFO, should assess the impact of financial decision and incorporate them in strategy formulation. I hope till this point we are clear. So, moving forward, we shall see how financial management and production management are having a kind of interdisciplinary aspect among themselves. Okay, now in every business organization, this production department is always concerned mainly with the arrangement of raw materials, machinery, technology, manpower, tools, and equipment. It is concerned with all these things mainly with the aim to facilitate efficient and effective production of either goods or service or sometime both. And they always aim or see to that there is complete they would complete the production targets within the time that has been stated. And also they see to that whenever they do a task within the time, it should also leads to minimize of cost on one hand, on the other they will also ensure the optimum utilization of production facilities. And to make all this happen, they always incur expenditures on, it could be raw materials, machinery, wages, or what we tend to call as operating expenses. Now, these expenditures that is concerned with production department are always estimated by production department, and once after they estimate, they would be sending for the approval from finance department. And once after the finance manager gets the quotation, he would be evaluating these estimates, and if he feels that there some changes are necessary, he would suggest those changes, and thereafter he allocates the required funds to the production department. That's how, when it comes for a business organization, the finance management and production management are in relation with each other. The next one we shall see regarding financial management and human resource marketing management. Now, every marketing manager in different organization or in most of the organization make marketing plans first. They also do the demand forecasting, and also they take a decision regarding maybe pricing of the product, how the promotion of the product should be done, how should be the product mix of a product, how should be the market segmentation, or how are we going to segment the market, how should be the targeting and positioning. Along with that, being a manager of marketing department, he or she should also decide the choice and length of distribution channels. Now, yes, definitely all these decisions or all these plans would be done from the side of the marketing manager. But we should always remember that each decision the management or the manager of other department takes involves finance. Now that's where the finance manager and marketing managers work together to evaluate the profitability of all the alternative or different marketing proposals. Now, once after completely analyzing all these things, or in financial terms we what we call as due deliberation, a financial manager approves funding for the selected proposals. Here we should always remember that not all the proposals that are being given to the finance department would be accepted. Only after analyzing and only after the finance department and the top level management are convinced that the investment is worth taking the risk, only then they would be investing. So let us see the next one. Here we shall try to understand how financial management and human resource management are linked with each other. Now, human resource management or this HR department is present in almost all of the business organization. Now, this department of organization usually takes several decisions that have financial implications or financial importance. Usually, those things which have financial implications could be like manpower planning, could be recruitment of new employees. It can also be the training and developing programs that are being conducted for the employees, and it also includes employee compensation, the benefits that the organization gives to its employees in terms of maybe wages, could be salary, could be bonus, commissions, perquisites, allowance. Now, that is where it becomes important that financial manager should discuss both the benefits and the costs of these decisions with human resource manager and approves funds to implement them. And in current days, we can also understand that the concepts of psychology and organization behavior, which were earlier only used by human resource department, are being studied by financial manager also, and this is being done with the purpose or intention to understand the behavior of investors. And this particular new area wherein the behavior and psychology is being understood is termed as behavioral finance. And this behavioral finance has grown rapidly in the past few decades, and it is also attracting the interest of especially the academicians and researchers in developing theory and also conceptual framework in the field. And not only that, they are developing this theory or concept, they have also found that it has very practical and useful in taking decisions, especially in their work. So, thereby, I guess we try to understand how financial management takes different ideas from different fields, or how is it involved in different other disciplines, could be in terms of organization, could be in terms of education. So moving forward, let us now see the objectives of financial management. Now, speaking about the objectives of financial management, it is generally or mainly concerned with procurement, allocation, and control of financial resources. Now, the objectives of financial management is definitely different for each organization. It depends upon many different aspects of the organization, right from the nature of the business, the values, the vision, the mission, or for that matter, even the size and the amount that they're having in the hand for disposing of. But the broad objectives of financial management for any organization can be discussed as follows. Now, the main objective of financial management is that it ensures that one, there is a regular supply of funds for the organization, and along with it being regular, it should also see that there is adequate supply of funds. Now, this adequate supply of funds tells that the fund should not be too much, or in other words, there should not be any overfunding, or there should not be any underfunding, but the funding should be adequate. The next one is that it should ensure that there is adequate returns to the shareholder. Okay, now here adequate returns becomes important from the point of view of two. The first one is business organization, the second one is the shareholders. Now, the shareholder would never tell, I would want a adequate return, because the more the return, the more satisfied and happy a shareholder would be. But here, when we speak about being adequate, here adequate returns become important from the point of view of organization. That is to tell, not all the money that the organization earns could be distributed among the shareholders. Some part necessarily should be kept in the hands of the organization, which would be helpful for the organization itself in coming days or in the long run. That doesn't mean all the profit that a company earns should be in the hands of company. So striking a balance between what amount would be retained and what amount would be shared becomes important. And having a balance between these two should definitely taken by the finance manager. Once he assesses everything, once he decides, he would be sharing the information with the top management or the board of directors, and it is the board of directors who would announce the decisions. Now, we should also remember that this giving adequate returns will always depend upon the earning capacity, the market price of the share, and also the expectations of the shareholders. Now, the next one is, yes, there should be regular and adequate supply of funds, adequate returns to those who have given the funds also, and along with that, there should be optimum utilization of funds. Now, optimum utilization of funds happens at that point of time in every organization wherein each rupee or the last rupee invested would earn the maximum profit and which experience the minimum possible cost. That is to tell, once the funds are being procured or once the funds are being arranged, they should be utilized in maximum possible way at least cost. Or it is as simple as how we used to learn in economics. There we used to tell every natural resources should be utilized optimally. In the same way, every rupee that a organization has should be utilized to the most optimum way possible. The next one is a financial manager's objective is to ensure safety on investment. That is to tell, it could be safety of investment of the funds of those who have invested in our business and also the safety of the investment of the funds which the business has invested. That is to tell, the fund should always be invested in safe ventures so that there is adequate return and also the minimum risk. And the one more objective of financial management is to plan a sound capital structure. Now, to speak about capital structure, in simple words, it is the combination of the equity and debt of the organization. So, there should be a balancing or a sound and fair composition of capital so that there will always be a balance maintained between debt and equity. That is to tell, as we discussed earlier, now every capital or the capital structure of any organization could be of three types. It could be wholly made out of the equity, it could be combination of equity and debt, and it could be wholly made out of debt. Now, having these three different kinds of capital structure has its own usefulness, has its own demerits. So, striking a balance in capital structure becomes very much necessary. So, regarding this particular topic or capital budgeting, you would be studying further in coming chapters under strategic financial management. So, there you would clearly understand why is it important to strike a balance between the capital and the debt and the equity of an organization. So, moving forward, let us try to discuss the functions of finance. We have already tried to understand this particular topic, and if I'm not wrong, in our earlier class, we also discussed regarding what are the four different kinds of decisions or the functions of finance. Now, please do not get confused between the function of financial management and the function of finance. Okay? Be very, very clear in understanding. If at all you have any kind of doubts, please do not hesitate to ask it again. Please do ask questions until you understand. Now, as we discussed in our earlier class, the finance functions is being divided into four different things. First one being investment decision, the financing decision, the dividend decision, and liquidity decision. We had also understood that the functions of finance is always a raising of funds, investing them in assets and distributing returns. And we also said that these three different things are nothing but financing decisions, investment decision, dividend decision. And when a firm attempts to balance its cash inflows and outflows while performing these three different decisions, it has to take some other decisions which are being called as liquidity decision. So, thereby we can divide that the first three decisions are and can be termed as long term financial decision, and liquidity decision can be called as short term financial decision or short term asset mix. So, now under long term finance decision, you have investment decision, you have financing decision, you have dividend decision, and under your short term finance decision, you have short term asset mix or liquidity decision. Okay, now you should always remember that a firm's finance function is simultaneous and continuous in the normal course of the business. Now, they never or they necessarily does not occur in sequence. That is to tell, it could be investment decision made first and the finance decision being taken later. Now, could it be any of the finance decision that we mentioned? It would always call for a skillful planning, controlling, and also the execution of firm's activities. Now, it becomes important from the point of view that now the shareholders' assets are the shares that they own, and the shareholders are always satisfied or better off by a finance decision that increases the value of the firm. So, with every decision that a financial manager takes, he should see to that there is maximization in the market value of the share. Now, speaking about long term financial decision, the long term finance functions or decisions, as the name suggests, have a longer time horizon. Generally, it would be greater than a year. Now, the long term finance decisions are those decisions which affect the firm's value in the long run. They will always relate to the firm's strategy and also involve the senior management or the top level management in taking financial or the final decisions of these financial activities. Now, under this long term finance decision, we have three. that is investment, the financing, and dividend decision. Okay, speaking about investment decision, a firm's investment decision involves the capital expenditure. So, they can also be called as capital budgeting decision. Now, as the name suggests, a capital budgeting decision involves the decision of allocation of capital or the commitment of funds to long term assets which would be yielding benefits in the future. Now, yielding benefits in the form of cash flow. Now, this is the simple explanation of what is being covered under investment decision. Now, as the time is running out for this session, we shall wind up here, and for the coming session, we shall try to understand what are the different decisions, how financial procedures and systems are present in Indian scenario, what is the role of financial manager, and we shall also understand what are the functions of financial management. I hope whatever we discussed is clear to all of you. If at all there are any troubles and questions, do let me know, because until unless you ask or until unless you tell, there is no way that I can understand how much you are being able to take in. So, if there are anything that you'll have to say, please share in your class group. If it is uncomfortable for you all to share in your class group, you can always tell me also individually. So, for this session, we shall wind up here. I would take your attendance, and later on you can leave the meeting. Okay, thank you class, you can leave the meeting for the day.